Just a quick one before we get started here. If you guys are looking to get funded, I'd highly recommend Funding Engineer. I've traded with them many times before and have found them to be the most trustworthy company to work with. They have 4 leading industry challenges here as we speak, and if you do want to support me, please do click the link in my bio and my description to sign up so I can continue giving away to you guys. You will also be entered into a bi-weekly giveaway when you sign up through that link. So that being said, we'll head back to the video. What's up everybody and welcome to today's new video, where in this one we're going over the full A to Z PD array guide that I've put together for beginners in order to master ICT's concepts. Now I know there's a lot of PD arrays you may see about, and I know this can be confusing, so I've put together this little slideshow to be able to show you all the different concepts and how we apply them each. Now before we do get into it, if you are new, please do subscribe and like the video if you enjoy it. I noticed that 81% of you aren't yet subscribed, so please do hit the subscribe button if you consistently watch my content. So by the end of this video, you should be able to explain to me and explain to yourselves what each PD array is and how we use it in context. Diving straight into the first one with probably the most common PD array you'll see, which is the fair value gap. Now, the fair value gap is a 3-candle formation. As you can see here, we have the first candle, we take the low in a bearish scenario, take the low, the second candle trades through it, and then the third candle trades and creates a high. So we take the low of the first candle, and then the high of the second candle, and this gap, which is made up by the second candle, I should have said the third candle there, this gap that's made up by the second candle becomes our fair value gap. So when price trades back into this gap, we can look for sells directly off the gap, or you can break down into a lower time frame and then work from there. But basically, once we break structure to the downside, this gap should hold as resistance. Now, in a bullish scenario, the exact same thing. The high of the first candle, the second candle trades through, the third candle creates a low and then trades away. And then we take the third candle's low and the first candle's high. This little gap in between here, which the second candle trades through, becomes our fair value gap. And when price trades back into it, like on this candle's wick, this may be the 4th candle or it may be the 10th, it doesn't matter. Once it's traded back into, we start to trade away. So like you can see here, we trade down, and then a couple candles afterwards, we trade into the fair value gap. And notice how oftentimes we'll trade through the gap and then close outside of it, like we did here. That's just another confluence to add for your notes. The same here, sometimes we'll just tap into the top of the gap and then run away straight away. Either of these are valid, and that is the basic premise of the fair value gap. Now, moving on to the second one I have here, which is the order block. Now, the order block is defined as the change in state of delivery. A lot of people on YouTube and on Twitter, rightfully so, call it the down candle before the move up. However, what they don't get right is it's the consecutive down candles before the move up. So it's not the very last one, that's the order block. If we have a 4-candle formation and then a move up, a 4-bear candle formation I should say, before moving up, that 4-candle formation becomes our order block. In this bearish scenario here, you can see 2 candles, 2 down candles, and then price trades above them. Once we close above them on this candle, so 2 down candles, the first one doesn't close above both of the down candles, so we don't have our change in the state of delivery yet. The 3rd candle, or the 4th candle I should say, trades above it and closes up there. Once this candle closes, we now have a valid order block. And how do we make order blocks more high probability? Ones that have taken liquidity and are paired with a fair value gap are more high probability than just a normal down close candle. So this one, for example, see this swing low here to the left of it. This swing low gets taken out during the down candle move. Then we close above it on this 4th candle, and then we trade back into it twice before moving away. This becomes a high probability order block because we've taken liquidity, and if you look inside here, this candle's high and this candle's low. There's a small fair value gap inside there. So both of these contribute to this being a high probability order block. And it's the exact same in a bullish scenario, so a bearish order block. We have price trade up, it leaves an up candle here, trades below, and then once we close below, remember, this becomes our order block. Now this becomes our order block, and then price taps into the body of it with this candle here. You could take a sell there with your stop loss above the order block's high, and then we trade much lower. Now order blocks are great when in continuation moves especially. So you may see this happen and then another order block here. And then as we continue upwards, down close candles or bullish order blocks should be supported by price. Now these should actually be the other way around. So this is your bullish order block and this is the bearish order block. Now a mitigation block is basically, if you are familiar with ICT's breaker block, it may look quite similar. However, it's not the exact same because it includes what we call a failure swing. Now, the bearish mitigation block, we have a high put in the market, trade lower, and then as price is reaching for this high, it fails to break the high. So we have a lower high, a low, a lower high, and then once we trade below the low down here, creating our lower low, and then tap back into the down close candle that's left, this becomes our mitigation block. So this down close candle here is our mitigation block. As you can see, marked up by the trend line here, you can see that this low, or this high, sorry, is lower than this high, which gives our failure swing. And then once we trade below that sequence and tap back into it, this is our mitigation block. And as you can see, price taps it and then runs away. Now in a bullish scenario, the exact same thing. We have a low put in, a high, and then a low, which doesn't go below the first low. We trade above this high, and now this bullish candle that gets traded through with this becomes our mitigation block. Failure swing, and then trade above the high that started the failure swing. So 1, 2, 3, trade above it 4, tap back into it, and now this is our mitigation block. Simple, right? Now mitigation blocks are really useful in higher time frame charts, I find personally. So I like to use mitigation blocks in the sense that if we have a 4-hour chart, for example, and we have this formation on a 4-hour chart, I will work inside of this block here, this mitigation candle, and I will drop down into like a 5-minute or a 15-minute chart and then build structure, you know, using these concepts on that chart instead. So I like to use the mitigation blocks on higher time frames as sort of a point of interest, okay? Moving on to what I mentioned previously, and we have the bearish and bullish breaker block. Now, a breaker block is, I'd argue, the most powerful PD array when you get it right and when you get it down. It is more than just a pattern because there's specific logic behind it as to why it works. Now, it's my favorite personal PD array as well, and when you start to see them and when you start to recognize it for what it is, you see it everywhere across all markets. Now, a bearish breaker block, we have a high put in, a low put in, and I'm just counting the swings here. I'm ignoring the little swings inside here. We're talking about bigger swings. So we have a high, a low, a higher high, so a high that it goes higher than the first high, low, higher high than the first high, and then as we break down below this swing point down here, so the second swing point we used to create the higher high, once we trade below it with this candle, you can see this candle here trades below the swing point, and then we trade back into the down close candles. Now, once we have this happen and we trade below, you take the 2 or the 1, however many down close candles it is, then first 2 down close candle at the lowest point, that becomes our bearish breaker block. So once we return back into here, you want to be a seller. Now, this can look like 5 bearish candles or 1, it doesn't matter. It's however many is left before the first up close candle, right? So in this case, it was 2, it can be 3, it doesn't matter. As long as we have a high, a low, a higher high, and then a lower low, trade back into it. And as you can see, I've marked up 1, 2, 3, 4, and then trade back into it with the fifth move. You start to be a seller, and look how dynamic this price action is down here. Now it's the exact same in a bullish scenario. A low, a high, a low, and then once we trade above it, you see we wick, but do we trade above this high here? Swing, and then once we trade above this high, you can see we don't with this candle, so we haven't got a bullish breaker block yet. Price consolidates a bit more, takes a dip into discount, and then moves higher. And finally, once it's traded through with this candle, here we get this big momentum up past this candle's high. We take the last up close candle in this bullish scenario, the biggest up close candle, and then extend it out in time. And as you can see, we trade above it. Price tags us in for longs, and then we go along there. So in this scenario, it was one up close candle. It could be 4, it could be 3, it doesn't matter. The beefiest up close candle, as ICT himself says, is the one we want to use, or the formation of however many down close candles it is before the first up close candle. Now, breaker blocks are powerful because of the logic behind it. You may have remembered I said that. Now, the logic behind it basically is we have a swing, and then retail traders are tricked into going long at this point because we've broken out above highs. And where would their stop losses be? Once they've gone long here, their stop loss would be below this low. We trade down below this low, taking their stops. And what else is rests below here? Sell stops. So we have retail trying to go short under this low as well. And then as you can see, price lags around. They're still in their shorts. And you've got to think, if you were in a short as a normal retail trader from here, as we broke down below this swing, where would your stop loss be? Most people's would be up here. You can see price bounced off this level, especially on this third candle multiple times. They see this level as resistance. We start to trade lower and then break above the high, taking their stop losses out. So both buyers and sellers have been tricked into the market. And then once we trade above, quick dip back into the breaker block, giving no chance for retail to get back on side and in line with the market. And that is why I went into specific details about this breaker block, because it is so powerful when you see it for what it is and not just an entry pattern. This is on like the hourly time frame all the time, and it's really powerful on those sort of time frames. Moving on, we have another PD array, which is old highs and old lows. I count these as a PD array, as does ICT. And I think they're obviously really important when trading ICT concepts because it's the premise behind the whole strategy. Now, this in bearish order flow, we want to see an old high tagged, as this induces retail into the market. Now, it's the same concept I went over before. You can see we have an order block here, break below, a tap into the order block, and then move lower. Now, that's probably about a 30 pip scalp in itself, but price goes up, and then above this high, back into the order block, which is still valid, by the way. That's a valid order block no matter what. We raid a high into the order block and then break down low with this momentum. Now you can see a lot of stop losses will be trailed from early sellers back here. So if retail sold back here, their stop loss goes above this high. Each high that's put in, they like to trail their stop losses, as you all may know, and as you all may still do. They trail their stop losses, so when price comes back and raises this old high, stop losses are taken out. So remember, early sellers are taken out the market, and now buyer stops also rest above this because some people trade breakouts. So they see this as a breakout, and then obviously people are going long with their stop loss above this low, below this low, and then we start to break down lower. Now, once you understand the logic behind old highs and lows, you understand how to use them. Once we see this raided, you can break down into a lower time frame, or you can do a turtle soup and just sell this high. As it trades into the high, just sell it. Okay? And then a bullish scenario, we have an old low getting raided. So we have price create a swing and then break higher, breaking market structure here. Now we have a low put in prior to the break of structure. And then this down close candle raids the low, taking out liquidity. and then moves higher. Now remember, the highest probability order blocks are the ones that took out liquidity. Now this one, you can see this down close candle here takes out liquidity. Remember, putting sellers into the market and then taking out early buyers, and then we start to trade higher. Notice how it all ties in together when we trade down into this down close candle with this wick and then shoots higher. Now, do you see how when you learn these concepts and start to actually know them for what they are, they start to tie in together? So I told you earlier, higher probability order blocks take out liquidity. We did trade higher and then trade back into the body of this down close candle, and then price shoots for the stars. So that is exactly how we use old highs and lows. Now, the RBRD, or the rebalance redelivered, is similar to a fair value gap, but not quite the same. Now, this is a reason why some of your fair value gaps don't actually get mitigated and price doesn't come back to these fair value gaps. So you can see here, we have the 3 candle normal formation of our fair value gap I taught you earlier, and price never comes back into it, right? So a lot of you are sat here waiting for sells and never get tagged in, and then price just keeps running lower. Now this, the rebalance redistributed PD array, is a big reason for that, right? So the algorithm works off of balanced price ranges and obviously sell stops and buy stops. When we have this PD array, you can see the yellow shaded area is the PD array itself. You can see price taps it and then runs away. This is a balanced price range. Well, it's not a balanced price range because that's a different PD array, but this is a redelivered rebalanced price range. It is this because we trade lower and then trade higher in the same candle. Now again, it's a 3 candle formation, so we trade lower with the first candle and then trade higher in the same candle. So we've delivered sell side and buy side with this move back up because we close up here in the same candle. Okay, the very next candle needs to deliver sell side again, and then this candle we can let it close. We take the high of this candle, and then where this candle delivered sell side and buy side again closed, we take this shaded area here, and this becomes our rebalance redelivered price range. The logic behind it is that we take sell side, or deliver sell side, deliver buy side, and then deliver sell side again. So the algorithm sees this as balanced and doesn't need to rebalance it. Therefore, we give room for an entry and tap into it, and then don't tap into the fair value gap that lies above it, and then price moves lower. So you can enter off of these when you see it, especially when you see it forming below a fair value gap. Now, bullish scenario, the exact same thing. We have a fair value gap here. You can see our normal 3 candle formation, high, second candle trades through, and then the third candle closes. This gap becomes our fair value gap. Now, price doesn't return into it before running away, and you can see why. The exact same thing I taught you here. This candle has buy side delivered and sell side delivered in the same candle because it closes down here. So the algorithm did deliver buy side and sell side in this candle. The next candle delivers buy side again, and then the third candle closes. We then take the area where this closed and then this third candle's wick. We take that area, and as you can see, as we trade higher, we retrace back into this zone before moving away. Now, this can be really powerful to know when your fair value gaps won't get hit. So if you see this above or below a fair value gap, anticipate it to stay open. Moving on to the rejection block. Now, the rejection block is really great for taking profits at. I find rejection blocks to be my number one place where price reverses on me. So if I'm in a buy, for example, from down here, and then I'm waiting for this high to get taken out, oftentimes it would just reject the rejection block and then trade back and take me out at break even. So I've learned over the couple of years I've been trading ICT now, I've learned to take profit at the rejection blocks, as this just provides the most security in your trade, if you will. So what is a rejection block? Well, in this bearish scenario, bearish rejection block is the last up close candle's highest wick, so the highest body of the up close candle. This wick becomes the rejection block. Okay, so price rejected from here the first time, ran lower, and then we trade back into the wick of it, and we can anticipate a move lower from this point. Now, you can see exactly why it's really good for taking profits, because obviously we like to take profits above highs and below lows, but in this case we have a strong rejection from this area already. Once we trade into it from a buy down here, I would already have taken profit at this point, because of how strong the rejection was, and because rejection blocks are just really good for that. So what does a bullish rejection block look like? In this case, we have the down close candle. You can see price rejected from this point and ran higher. The down close candle's wick, this area here, becomes our rejection block, because we trade lower and then move higher. This down close candle caused the rejection. We take that body close, extend it out in time, and then we trade back into it. So let's say you're in a sell from up here, you can see no rejection blocks formed, and then as we move away and it retraces into this bearish order block, you can see that we just start to trade lower. At this point, I would be looking to take our profit at the rejection block just formed. Now, I'm sure you can see how these would be useful, and when partnered with everything else, you now have a specific area and price to take profit at. And these, when used the right way, are very useful. So that brings us to the end of the video and all the PD arrays I wanted to teach you today. So I just want to thank you all for watching, and if you did learn something new / enjoyed the video, please do subscribe. We're posting 2 times a week, and drop a like and comment if you have any feedback or you did just enjoy the video and want to support my channel. Now remember to click the link in my description if you are looking to get funded, as I've partnered with Funded Engineer and we do bi-weekly giveaways. So we do a 3 times 10k account giveaway every 2 weeks, and that is just my way of giving thanks to any of you who do support my content. So make sure to check out the Twitter, as that's where I host them all. And as I said, if you did learn anything new, please do drop a like, subscribe, and drop a comment. And make sure you check out all my links to my socials. So with that being said, I'll see you in the next one. Thank you all for watching.